Hi, everyone. Thanks for the kind words, Matthew. Thanks for the opportunity to talk to everybody today. Thank you particularly for giving me the slot right after the sugar rush of lunch has gone, and as I'm the last obstacle between you and the happy hour, this is the slot to be giving a presentation. So thanks for that. Thanks for that opportunity. I do want to say thank you to everybody for sticking around to listen to this. I also want to say thank you to whoever designed the color scheme that matched perfectly with the Venture South duck over here. So thank you all for all the small ways that you guys have accommodated Venture South as we have brought you some content this afternoon and hopefully bring some more angel investing activity to the Jacksonville area as well. If I could just have my clicker, I can use the slides and help bore people with the slides as well. So I don't have great stories about faith, breaking glass ceilings, or any of the fun content that you've seen all day today. All I've got is some slides and a strange British accent. But hopefully those two things are enough to keep you entertained for the next 45 minutes or so until we get to that happy hour. I'm thrilled to be up here talking to you and look forward to answering your questions about Venture South, about angel investing, about all the stuff that you would like answers to. Happy to do my best to supply those today. My name is Paul Clark. I'm one of the co-founders of Venture South. If you hate this, then it's my fault. Tell me afterwards and we won't do it again. But if you like this and get something useful out of it, hopefully you'll remember that. Feel free to link with me on LinkedIn. Love to chat with you. If you're raising money as an entrepreneur, love to chat with you. If you are a potential investor, we'd obviously love to have you as part of Venture South. If you are an aspiring angel investor, hopefully you learn a couple of things from today that will help you be a better angel investor. Matthew's mandate to me today was come and do a little bit of education about what angel investing is, but don't bore everybody with the stuff they already know. So we're not interested in term sheets and deal terms and cap tables and all the stuff that we do education-wise all the time at Venture South. What we actually want to know is what happens on an early stage deal and where did you guys screw up so badly in the last 15 years of the investments you've made. So to try to answer that question or to share some of those stories, my goal is to work through a few case studies of investments we've made where I will give you the positive spin that gets put in the press releases and the Wall Street Journal about what happened and how great early stage investing is, and then share some of the reality with you about what happens behind the scenes to either make that happen or what really did happen behind the scenes, which is the truth behind those positive spin press releases. So that's my goal for the next 20 minutes or so to go through those case studies, share some of the lessons we've learned from our investments, our exits, our disasters, our recoveries, our hair pulling, and all of the other stuff that we had to do to get some positive return from angel investing. I would like to try to leave you with a couple of things. First of all, I'd like to try to convey to you a couple of things. One, this stuff is hard. Early stage investing is difficult. As several panelists mentioned, you will lose money doing it. All of that is true. But I also want to leave with you the idea that you can do this too. That if I can do it, you absolutely can do it. And everybody should do it because, as you heard from some of the other presenters and speakers, early stage risk-tolerant capital is the lifeblood of dynamic economic and entrepreneurial ecosystems. And we want to just encourage more people to do that. You can do that on an online platform for $100. So we're not talking about being a billionaire and funding huge checks into lots of companies. You can start this at a very small scale and have a significant impact on a lot of people if you do it. And plenty of time for questions. So that's our goal. I do want to quickly start off, though, with a quick hello from Venture South so you know why I'm up here talking to you about this stuff. Venture South is an angel group. We're a big angel group. We're one of the top 10 angel groups in the United States. An angel group is just a place that rich people, generally, affluent people, get together and make investments in startup companies. If you've invested in any company, a friend, a colleague, anything, you are an angel investor, even if you wouldn't have necessarily credited yourself with that title. We do it in a more formal way in a group setting with a lot of people doing it together, so we're a formal angel group. We have these in cities from Jacksonville, Florida, all the way up to Richmond, Virginia, Norfolk, Virginia, across to Chattanooga, Tennessee, and all those cities where you can see a duck on the map there. We get together in person with groups like you to look at, to evaluate, to do diligence on early stage companies, to aggregate our investment capital in them, to make them be successful with advice and support, and reap the financial and psychic rewards, the personal fulfillment rewards of helping early stage companies be successful. That's what we do. There's about 480 people that are part of our group over those 21 markets. We've invested in 100 companies, nearly $80 million into those companies. We invest in them repeatedly. And for some reason, places like CB Insights and the ACA keep telling us we're one of the top 10 angel groups in the United States because we do a lot of angel investing. And I'm going to share with you some of the lessons on where we have done that badly and where we think we are getting better at it so that you can perhaps shortcut some of those lessons learned for your personal investing activity. We invest in Southeastern startups that are raising somewhere between $200,000 and $2 million. So if you fit those fairly loose criteria as an entrepreneur, we'd love to hear from you. We will invest in just about anything that we can understand. All of our members decide each time if they want to participate in a deal or not. So you don't have to convince 480 people at Venture South to invest in you. You just have to convince a few of us that you have something that is backable, and Venture South can aggregate their investment into your company. We typically buy equity in companies. I'm not going to get too far into the weeds of how all this stuff works, but that does mean that we are going to be partners with this investee company for a long time, potentially much longer than any of us really want, but the goal is 3 to 5 years, something like that, maybe a few years more than that, as a financial partnership to drive these companies to grow and to exit and to generate wealth and economic opportunity for the communities that they operate in. So that's what we do. We have a full-time team of 11. My colleague Charlie's here too. He's going to come and join us for some of the Q&A afterwards. We're pretty unusual in that we're a full-time team doing early-stage angel investing. There aren't too many people that do that. We've built an infrastructure to allow a lot of people to participate through our group in a relatively time-unintensive and easy way if you want to. And then we have members like Julie that want to take a much more time-intensive way and participate actively in the companies that we operate or that we fund and in some cases even operate. So that's the quick intro from Venture South. I'll jump straight into the case studies of what an angel deal might look like, where we brag about the wins, but also give you some of the reality behind some of these victories. So the first one is a company called Target Pharma Solutions. They're a company out of Chapel Hill, North Carolina that we invested in 2016. Meg Powell was the CEO. This company is a phase 4 clinical trial data management company. So you're probably all familiar with how drugs get to market, right? They go through toxicity studies, they go through efficacy studies, they go through the FDA, through a phase 3 clinical trial to prove that this drug actually works and therefore it can be sold to people. What you might not know is that after that, the drug companies have to continue monitoring all the bad things that this drug does when it's exposed to the wider population. And those are phase 4 clinical trials. And that costs drug companies a lot of money. They have 50 drugs, they're doing all of this monitoring of data all the time. The idea behind Target Pharma Solutions was that why don't we take all of that regulatory requirement, collect all the data on all the drugs on a particular disease, and then sell that data back to the pharma companies and anybody else who's interested in it. So flipping that kind of on its side, getting population-level data on who's taking hepatitis C drugs, and then selling that to some of the most deep-pocketed corporations in the country that buy data from you. So pretty good idea. We liked the idea. We liked what they were doing, relatively capital unintensive. They were raising a $2 million round, so at the higher end of the things we would look at. But this was an angel deal in our footprint that we thought was really pretty cool. We were fortunate enough to invest in the round, and 2 years later, we sent out a pretty happy press release where we had turned our investment in that company into 10 times the investment in that company when we sent distribution checks back out to investors. So obviously that's the case study I lead in all presentations whenever I'm talking about Venture South. That's a 10x in 2 years, a little over 2 years, 183% IRR. If you guys know any other companies where we can do that, please do email me because we'd love to do a few more of these. This is the sort of, when things go according to plan, this is what can happen on companies that do well. It was acquired by a financial buyer, Norwest Venture Partners, who are a well-respected VC, PE, kind of growth PE fund. Major success story, female-led entrepreneur, pharma data company in the Triangle, which was just going through sort of an explosive growth phase as well. It was a great story. And there's another 2.7 times our return potentially available if the company hits some earnouts. So as you can probably guess, we're pretty pleased with that. We publicize that all the time. The reality behind that, though, is a lot had to happen to make that happen, and it's not the full story. So here's a couple of bits of cold reality to throw on that delicious story. The first is, we were the only angel group in that deal. There were a lot of people that wanted to invest in that company that couldn't, which is unusual. Most early stage companies in the Southeast are not filling their rounds and cutting people out of the deal. But we were fortunate enough to know the CEO very well, and were able to prove to them that we could move quickly enough and write a big enough check in the time frame to fit into that process. So one of the things you need to sort of think about as an investor is, can I find and get into the best deals that I can? Or am I, for some reason, only looking at crap deals, because those are the deals that are coming to me for some reason. So making sure you have access to deal flow is a very subjective thing to be talking about, but you want to try to make sure that you are able to be in the room where the deals happen that you want to be in. And that is not necessarily straightforward. The reality in the Southeast is that's not as hard as it is in Silicon Valley or other more established entrepreneurial ecosystems, maybe. We all generally are more collaborative, and few people have big enough pockets in the Southeast to fill deals up immediately. But access to deal flow is important. We were fortunate to be able to get into this deal because of pre-existing relationships, but we really shouldn't, and a lot of people didn't. The other interesting things about this exit are once you are working with VC funds or private equity funds that come in after you, you need to be acutely aware that they do not care about early investors at all. They have their agendas. Their agenda is to make money for their limited partners, and it can very well be at the expense of all the existing investors in the deal. So investors always act in their own self-interest, and it becomes more acute as those self-interests have more dollars behind them. And so one of the things at Venture South that we like is when VCs come in and fund the companies at big up rounds for our companies, great. What we like even more is when they don't do that, when we give the company enough money to be successful without having to bring in later capital providers whose interests are not necessarily well aligned with ours. So although I'll tell you that the goal to have $1 billion of VC money in Jacksonville is a great goal, it's even better to just have angel investors making great deals on their own without needing that, because life is a lot easier for those angel investors if they can do that. So just to caution that investors always act in their own self-interest. You'll notice that I also mentioned that earnout at the beginning, or on the previous slide, where we would get some more money if the company hits certain metrics. The reality is earnouts never get paid. So just one small tidbit for you as investors, if a deal comes to you where you have the opportunity to take some money off the table and there's an earnout, look very hard about the probability of you getting that earnout, because even in companies that are doing really well, getting that money later on is extremely hard to do. I'm not saying it never happens, but rarely do things go according to plan after an acquisition, so that money gets put into our pockets as investors, because again, none of the people involved in the deal at that point want to put money in my pocket at that point. So earnouts typically don't get paid. So that was one where the reality wasn't quite as shiny as the reality, although still I'm happy to brag about Target Pharma Solutions for a while. The second case study is a slightly scaled back version of that. This is a company out of Durham, North Carolina. I don't know if you guys saw the Gartner adoption curve that was up earlier with ag tech on it, but satellite data for farmers was over there on the right-hand side of that. So an established technology at this point. 7 years ago, when we were looking at investing in farm shots, that was not the case. They were before the trough of disillusionment on that chart. This was an early kind of idea of using satellite imagery, processing it, and using it to tell farmers where exactly on their farm their plants were suffering from a fungal disease or whatever, using the light coming off the plants, rather than having to send people out to go manually check on those plants. That was pretty cutting edge 7 years ago, before drones could do it, before satellite data became more ubiquitous. So we invested in this company out of Durham that did that. We actually invested in basically this guy. It was a two-person show. He was a recent college graduate, so a very young guy, very early stage deal. They were raising, I think $400,000 or $100,000, a small early stage angel deal. At that point, a pretty nice valuation because of the inexperience of the CEO and the early stage of the company. So on the deals that we do, probably an earlier, higher risk kind of investment than we would typically do. But again, this resulted in a positive outcome. We sent out a positive press release when this company was acquired by Syngenta, who are a big sort of ag tech conglomerate, who snapped farm shops up in 17 months after our investment. We made almost 2 times our money, so a 50% annual rate of return. Our goal when we invest in companies is to find ones that can generate us a 50% year-on-year annual rate of return. So 10x in 5 years or something like this from farm shots. Most companies don't do it, but this one did. It was a quick early exit, quick sort of in and out, recycle the proceeds. We can go on and do it again. We were very happy with the press release. The actual process of getting this company bought was a colossal mess. And not to denigrate the corporate VCs who were providing information earlier, but large corporations, especially ones that are growing sort of through acquisitions, are very hard to work with because they have all the leverage over a startup. And so getting acquired by companies like this is super hard. There were several other problems with this. The first one was when we invested in this company, there were 4 or 5 places you could go and buy satellite data from. Within about 6 months of us investing in this company, that company, or one of the companies in that space, had acquired 2 or 3 of the others. One had gone out of business, and we were basically left with a monopoly supplier of this satellite data to farm shots. And you can probably guess what a monopoly supplier of data does to a company that's buying data from it. The price went up by 10x, like nominally the data that they were trying to buy. It came to the point where there wasn't a financial case for the company to buy this data anymore. They essentially couldn't do it because the monopoly supplier had all of the leverage. So what did we do? Obviously, we panicked. There's nothing else you can do in that kind of situation. How do we get our money back from this investment when this company is really not viable anymore because there's no space in that value chain for it? So we've got to try and sell it. What can we do? Well, a couple of things we need to do is, one, keep the team involved, because we can't sell this at all if all those entrepreneurs have gone back to school. So step one, keep the team together, keep the band playing, give us some time to figure out what we can do here to make this successful. The second is make a fuss. So if your supplier of data doesn't provide you with the data, you've got to try to make a fuss about it and be a pain in the neck. Fortunately, at Venture South, we are very good at being pains in the neck, and we encourage our entrepreneurs to be pains in the neck too. So have them just try to make a fuss and fight, try to stay alive. That was the sort of second approach. And the third was to try to figure out who can help us here. Who has some leverage with this supplier of data to help us get to a point where we can sell this company to somebody with some value in it. The monopoly supplier of data made us a very low-ball offer to buy the company. That was nice of them. We tried to negotiate that up. We didn't really get very far. It wasn't going to be worth the effort to go through that challenging relationship to get the deal done. So we had to try to find somebody that could be our rescuer, our white knight. Fortunately, we had some resources at our disposal. So on the board was somebody from a company called the International Farming Corporation, which is a big ag tech landowner, who knew Syngenta, which was also based in Durham. So there was some local knowledge, some relationships that we could tap into, where we could go to find somebody big who also bought data from the supplier and thought there was value in what we do, to try to argue on our behalf that this company was being short-sighted when 10xing the price tag on the data we were buying from them. And we managed to get them to acquire us. It wouldn't have happened if we hadn't gone through that process and didn't have a board member or two that were engaged and able to deal with that. And so the reality of that press release was this would have been a zero had people not helped it not be a zero. Particularly as you saw the picture of the CEO, this wasn't a guy that had been through lots of arguments with large corporates in his life. He was a fresh university grad. He had no idea really what he was doing when it came to this kind of corporate intrigue. So having the right people on your team as an entrepreneur is crucial. Tapping into relationships that you have is critical. Asking people for help is very important. Providing therapy to CEOs and keeping them engaged as an investor is probably the most important thing you can do as an investor. And as a result, I have lots of cups of coffee with all of our CEOs that are part of the Venture South portfolio, just to be a sounding board for them to complain to and occasionally provide a little bit of value to help them if I can. So that was the reality behind another positive result at Farm Shots. This is a different story. This is a pretty typical outcome for an early stage deal where we lost money. So Periomics is a company out of Virginia. They had a single test to diagnose whatever strange infectious disease you have. So if you have a chronic condition that you just cannot figure out what's wrong with you, you can send a blood sample to Periomics. They will pull out all the DNA that's in that blood sample, including the DNA of any potential pathogen that's in there. And there are a surprising number of fungal, viral, parasitical, bacterial infections that you could have that your regular doctor or the health system is not going to be able to pick up. As an example, they had a patient from Arizona, I think, that sent in a sample. Nobody could figure out what was wrong with this person. They were chronically fatigued. They were, really struggling with, day-to-day health. They had tuberculosis caused by a bacterium that nobody really suspected you people had. So those kinds of tests were something that we thought was pretty cool. The science behind it was established. It wasn't science fiction. It might remind you of another blood-based testing company they make Netflix shows out of. It wasn't like that. this actually worked. We saw the DNA, we saw the reports, we saw the paying customers, we saw a lot more reality to the business than that when we invested. They had a couple $1 million of revenue from people cash pay ordering these tests. So we invested in the seed round and we lost all our investment on it. We invested in the convertible note round that came after that seed round and lost most of our money from that note as well. And we put some money in a last-ditched rescue attempt to keep the company in business and get it sold, which we did. And so obviously the press release that goes out on this one is that this company is successfully acquired by LabCorp. Everybody's very happy with the result. We didn't send out this press release. One of our investment partners did, which is an exercise in very positive spinning what is in reality a pretty significant capital loss for most of the people involved in the deal. But if you just read the press release, you'd think this was another win in the Venture South column, but it wasn't. So I guess one other thing to encourage you is don't, as one of the earlier presenters said, don't believe the hype about what all these great entrepreneurs are doing. Also, don't believe the hype that you read about angel groups or VCs or anything that comes out of Silicon Valley tech press, because the reality behind it is probably considerably different. The reality on this was the latest round of note holders got their money back. Those notes were designed to bridge the company to be acquired. So the entire goal of that round of funding was to give the company enough money to survive 3 months to see if we could persuade somebody to fire sale buy it, which in reality was probably not a great investment decision or opportunity, but we had enough people that wanted to do that for philanthropic or medical, treating patient reasons to do it. There were enough takers to do that note. And the note paid off. Nothing like the return it ought to have done, given how risky that capital was, but that note paid off. That didn't please most of the other people on the cap table who still walked away with nothing at the end of it. So not only had they got a zero, they would have got a zero had we wound that company down, not done anything. They still got a zero despite 6 months of effort and pretty paltry return for some investment capital. This was one where I lost a lot of personal relationships with other investors, with the management team. There was just a tremendous amount of argument and discussion and hostility and challenge with that whole deal because nobody likes to lose. And in a situation where we're all going to lose, figuring out who loses the most is a hard situation to be an investor in. So obviously you probably appreciate the liquidation of fire sales are hard. I strongly recommend not doing that. If you have the opportunity as an investor, let your zeros come, because often it's not worth the headache to try to recover any value from those, and be tolerant of the fact that you probably will lose money. Be particularly aware when you're on a board of directors of a company that you are in the firing line for everybody to hate you as a board of director. Investors, other board members, the management team, everybody dislikes the board members that watch a company or even help a company liquidate. So that is my most painful sort of case study that I've got, because I aged a lot during that. As you may not be able to tell, but you probably can tell I aged a fair amount during that process. Lost a lot of respect for my peers that were also on that I thought were not doing what they should have done, and I think they don't like me as a result of that as well. So these can be difficult situations when companies wind down. So on that super negative note, I'll just give you one last case study of a company that we also kind of like to brag about, and is topical to the transportation center we're in today. We invested in Proterra, which is an electric bus company out of Greenville. Not, you might think, a typical early stage angel investment, capital intensive. They make electric buses, so there's obviously quite a lot of capex that go involved in that. They moved to Greenville from Colorado, I think, in 2011. They had some funding lined up from a Brazilian entrepreneur who then got arrested and went to jail. And the company was weeks away from closing down, having just moved to Greenville with lots of celebration about, oh, how great is this to have an electric bus company moving to Greenville, improve our manufacturing. This is a great sort of story about Greenville manufacturing renaissance, with an investor that's just about to go to jail. How can we keep this company alive? Fortunately, we had an angel group in town that was, had enough people in it that could make payroll for a little while and help us bridge to some more substantial sources of capital that could take this company forward. That source of capital became Kleiner Perkins, who are a well-known VC fund. So we were a very small piece of a bridge to much bigger fish later on down the line that we like to continue to brag about. Early stage companies needing smallish amounts of money, angel groups is the place to go, while the VCs get that act together to make really transformative investments later. So we were also fortunate that after that initial success of keeping the company alive, we continued to be allowed to invest in this company over time. And we did that. We invested nearly $6 million out of the Venture South membership portfolio in, I think, 11 rounds of investment the company made or raised after that. Smallish amounts. We know we were a tiny percentage of the cap table at the end of all that money going in, but we really liked that story because we saved the day. We had lots of follow-on rounds. This was a great story. And then the company went public in 2021. So that's the sort of icing on the cake for good exits for angel groups, is when companies go public, send a lot of money back to the investors, spread the wealth around all the investors in Greenville that made tons of money from that IPO. That's my story. Normally I stick to it. The reality is we didn't actually make very much money on that deal for a lot of reasons. One is we got heavily diluted by lots of rounds of capital. So they had to achieve a massive valuation at the end to really pay us a lot of return. We made a decent amount of money out of it, but I'm still here talking to you about this stuff, not lying on the beach in Tahiti. So we didn't make tremendous amounts of money about it. We also went public with a SPAC. I don't know if I need to explain to you all that SPACs suck, but if you're an investor in any company that got SPAC'd, then that probably isn't a good result for you. If you were the SPAC manager, you probably made mint. But if you were the investor in the companies, you probably found a new way to get screwed when this is the new way to go to IPO. It's also a pretty good learning that the public markets and the private markets, like what we do, are totally different. So if your comfort zone is you want to invest in late stage companies that produce cash flow that you can value on a free cash flow metric, DCFs, all of those later stage companies, it is a big shift to the private markets where none of that really applies. And when those two things clash, like during a SPAC, the outcome there, the public markets win. So the outcome there is not necessarily good for those of us in the public markets because the dynamics are just different. We also had a whole bunch of problems around the team turnover, about the location turnover. You saw they moved headquarters. There's a lot of other story behind that I'm not going to dig into. But that was a pretty painful, long lesson in what happens when big fish come in after an early stage deal and don't necessarily do what you hope they will do. The extra bad news is that I still check the Proterra share price every day and see that it's stuck at 4 when I want it to be at 24. And so public market exits are a pretty painful outcome sometimes for investors when they don't go totally according to plan. So I hope nobody was recording any of that I shouldn't have shared with you guys. But those are some of the case studies and the lessons learned and some of the pain that's behind some of the early stage companies that we have invested in. I'll boil that down to you, but I changed the messaging a little bit. First of all, anybody can do this stuff. We can all make mistakes. We can all be angel investors. You do not have to be one of these Shark Tank celebrities. You do not have to be very exciting at all. You can sit in one of these beige rooms where we hold angel investment meetings, just along with other regular people like you that make early stage investments. You do not have to be the owner of a sports franchise, an airline, or any other criminal enterprise at all to be an angel investor. Obviously, it helps if you are, but you don't have to be. You can just be a regular person. And so let me just clarify that a little bit. So to be an angel investor, the sort of accepted definition is you have to be an accredited investor, which is what the SEC call you if you are sufficiently wealthy. There's about 16 million households in the US that are accredited investors that can invest in any startup with basically no regulations around it. You can still be an angel investor even if you don't fit that criteria. At $100, you can go on a WeFunder as an unaccredited investor and make an investment in a startup. And we encourage people to do that because everybody wants to learn in a small scale way. Even $100 is helpful to startup companies scraping together every dollar they can to be successful. So you do not have to be, as I say, a criminal enterprise mafioso leader to be an angel investor. You can start at a small scale level. If you want to do it through an angel group, you've got to find an angel group that does what you want it to do. So like Julie mentioned, you've got to find a way. Do you want to be active or passive? Do you want to be actively involved in the companies? How much are you willing to put into this asset class where you might lose the money? And what do you want to try to get out of it? If you want to participate in Venture South, there's a membership fee to join, but there's no obligation to invest in any of the deals that we do. So I'm not coming to you and saying, I need a $100,000 check for you to invest in 10 companies. I am going to say, here's 10 companies, pick and choose whichever ones you want. And if you want to invest in them through Venture South, that's what we do. So we can help you do that. So limited obligation, nobody's making investment decisions for you. That's the approach that we use to try to encourage as many people as we can to dip their toe into the water of early stage investing in a small scale way. You'll remember that The duck is the Venture South logo, so all my next slides are ducks getting increasingly perilous situations. When you're an early stage investor, you do not know what's going on under the surface behind these deals. So if you're reading a press release about what happened, like on a Periomics, you think we made a bunch of money on it. We didn't. You can't see all the legs underneath this duck paddling furiously to keep it moving. You can't see the reality underneath these deals. So it's very much an important factor of early stage investing that this is much better done in groups. You are a much smaller target if there's a hunter around, if you're in a group of other birds, right? If you're an angel investor, you have a much greater chance of not making an elementary mistake or missing something in diligence or making a poor decision somehow if you're bouncing ideas around with other people. So we say at Venture South, we're better in groups. I only do this because I'm surrounded by 480 people who are way smarter than I am about all the companies that we look at. Much deeper industry expertise, much greater experience, all of that. I don't have that. I do bring a fair amount of fundraising experience and early stage terminology knowledge, but I don't bring the breadth of knowledge that our members do. You can be a very successful angel investor on your own, and you're a genius if you are. I'm not. I like to surround myself with other people that are smarter than me that can help me do this well, and that's the recipe that we're comfortable with. We think it's better in groups. And you never know where the danger is going to come from. It might be the IRS decides suddenly that's a problem. It might be that the Medicare reimbursement rules change and your business can't charge for what it was charging for before. It could be a regulatory problem. It could be your customers just change. It could be a competitor just raises a fund from Kleiner Perkins. It could be that your investor goes to jail. There's all kinds of reasons that you could fail unexpectedly, even as an entrepreneur doing the best you can to be successful. So as an angel investor, you never really know. You can never really do a pre-mortem on a deal. It will fail for a reason you didn't know about before, but hopefully you can avoid that particular scenario the next time you do it. So maybe some of these case studies have given you some extra things to look out for where the alligators might be in the deal that you are involved in. The other thing that we do at Venture South is try to help the companies. We don't send you a check as an entrepreneur and say, go and do something with this and send me 10 times our money in 26 months. We serve on boards. Our motto when we serve on boards is noses in, fingers out. So we want to know what's going on. We don't want to be a pain in the neck to you as the entrepreneur. We want to be as helpful as we can. And so we have people, you just see their names on the screen here, that are members of Venture South that serve on the portfolio company boards. And I don't know if there's any of those in the room. Judy was here earlier. She's one of those. They do a lot of work to help companies be successful. And those are, again, just regular people volunteering their time and brain power and experience to help entrepreneurs solve the problems that the entrepreneurs are trying to solve. So that's, was it too slow? Here you go, I'll go back. Don't share these names with people, but that's fine. You're good to go. The other suggestions we have is that really good entrepreneurs are asking for help all the time. Really good investors are both answering those requests and providing their own suggestions all the time. Most people aren't doing either of those things, which is one of the reasons 96% of companies fail in an earlier presentation. Really good entrepreneurs and really good investors are constantly having a dialogue about how can we help, who do you need to talk to, who at CSX do you need to go and see while I'm in Jacksonville. Those kinds of conversations need to happen all the time because the odds are so heavily stacked against any startup that you've got to do everything you can to tilt those odds slightly more in your favor. Another thing that we specialize in at Venture South is raising money. We are an investor, so we invest in the first round of deals. We therefore see 70 companies that go on to raise more money. We are on the receiving end of a lot of term sheets and a lot of discussion with VC funds about what the next round of investment might look at. So if you're an entrepreneur and you've not done that before, well, there's somebody in your corner now who would like to help you get the best deal for you and me as part of that future fundraising. So we spend a lot of time at Venture South looking at incoming term sheets, educating entrepreneurs on the implications of those term sheets, what your dilution looks like, what your cap table looks like, why it's a terrible idea to raise another safe on top of the 2 previous safes you just raised, all kinds of reasons around fundraising and suggestions on how to do that better. We do that all the time. And then we try to make as many connections as we can. Sales connections, recruitment connections, any kind of way that we can try to be helpful, we try to do it. Now, we only have a limited amount of time in our lives to do this, so I don't do this 24/7, but I do have access to 480 members who I more or less know who most of them are at this point, and so can make those connections pretty quickly when I meet John, who's in the preventative maintenance space, and we have a preventive maintenance company on portfolio, I'm going to make that connection later, whether he likes it or not, because that's my job to help these portfolio companies with those kinds of connections. So if you're an entrepreneur, one of the good capital things is somebody that is willing to do that for you, and that proves that they do it. One of the bad flags of a bad investor is they just don't do that, and they just give you the check and let you fend for yourselves. So those are some of the things we do to lessen the pain of those case studies that I went through earlier.